Dr. Drennan received undergraduate degrees in economics, mathematics, and biology from Southern Methodist University. He earned his master's degree and Ph.D. in insurance and risk management from the Wharton School of the University of Pennsylvania. Dr. Drennan conducts research on managed care and employee benefits and has published articles in the Journal of Insurance Regulation, the CPCU Journal, Benefits Quarterly, and the Journal of Insurance Issues. Rob, we're pleased to have you here today.
Thank you, Marty. I'm pleased to be here. Welcome to all those who are listening. This assignment we're going to do today is the third in a series of 4 assignments. Some of you may have heard me do the insurance principles a few weeks ago. I was followed by my friend and colleague David Eccles from the University of Georgia, who did insurance coverages, property and casualty. And today I'll be doing insurance coverages, life and health. After my presentation in a few weeks, Dr. Eccles will return to do insurance regulation and legislation. So the subject of today's webinar really involves what amounts to how individuals manage losses to what we might call human capital. So everyone has human capital. There are certain random events that can occur to individuals to damage their human capital. So, for example, they could become disabled, they could become sick, they could die. In these cases, there are losses that are created. And so there's a loss of income in the case of life insurance, for example, and medical expenses in the case of health insurance. We're also going to discuss annuities. So really, life insurance and annuities really are ways to manage what we might call mortality and longevity risk. These types of products or insurance products can be purchased individually, but they're also often acquired by individuals through employee benefit plans. So as I said, the segment is we're going to start with 3 distinct topics, and I will tell you that we could have a webinar on each one of these topics. So I'm really going to hit the highlights in each area. So first we're going to talk about life insurance, then we'll be doing annuities, and then we'll be doing a section on health insurance products. So let's start with the types of life insurance. So a fundamental building block of all life insurance contracts are term insurance, which I'll discuss in a moment. And then we have the next set of types of life insurance, which we would basically call those cash value types of life insurance products. So those include whole life, universal life, variable universal life, and then there are some specialty products that are a combination of all of the above to meet various specific needs.
Rob, at this point, we'll just stop and ask you, and we'll ask our audience, what do you think? What are some of the differences between term and whole life insurance? And we invite our participants to use the Q&A box to give some of their thoughts on this as we move forward.
All right, so sort of the fundamental starting point for discussing life insurance is considering the issue of mortality or probability of death. So, for example, if we have 1,000 individuals who are alive at the beginning of age or year T, you could be thinking about age 20, age 21, so T is 20, T is 21, for example, then if they're alive at the beginning of a particular year, then if you fast forward 1 year, some will still be alive and some will die. So we think about of 1,000 people who are alive at the beginning of year T, X of those people will die between, say, T and T plus 1, or maybe 20 to 21, or 21 to 22, and then the remainder will survive. So we can say that X out of 1,000 will die. So let's just suppose for a moment that that X equals 1. So at some age, a relatively young age, if you have 1,000 people alive at the beginning of the year, then perhaps one of them will die, meaning 999 will survive. So let's suppose that this group of 1,000 people wanted to form a risk pool or an insurance arrangement or a risk-sharing arrangement where they wanted to provide $100,000 of life insurance coverage. So the question we now have to find out is, well, how much do we charge for that insurance coverage? Or if it's for a risk pool, how much would each individual have to put into the risk pool so that if they were the one who died, then their beneficiary would be paid out $100,000. So we kind of go back to some principles that I talked about in my first webinar. The pricing of any type of insurance coverage, whether it's life insurance or property insurance, depends on the probability of a loss occurring, and it also depends on the dollar amount of the loss once it does occur. So the probability of a loss occurring we call frequency, and I have that abbreviated by the letter F, and the dollar amount of the loss once it does occur is known as severity, and we have that abbreviated by the letter S. So basically we think about frequency and severity, probability of a loss happening, and the dollar amount of the loss once it does happen. So if 1 out of 1,000 people are going to die in this risk pool, then the probability is 0.001. So that's the frequency. We multiply that times the loss payout. We already know what the loss is going to be. It's $100,000 of life insurance coverage. So if you do the simple math, you'll say, well, each individual in the 1,000-person risk pool should pay $100 to be in this risk pool. What they're buying basically is a promise that if they're the one who dies, then the risk pool will pay out a beneficiary $100,000. So it's $100 for $100,000 of coverage. So for each $1,000 of face amount or each $1,000 of coverage that I want, I have to pay $1 per 1,000. So what we've kind of noted here is there is a very direct relationship between the probability of death, or we might say in life insurance terms it's called the mortality rate, mortality experience, however you want to think about it. So the term mortality is involved. So notice that we had 1 out of 1,000 individuals who were going to die, and if that's the case, then they have to pay $1 per $1,000 of face amount. So the 1 per 1,000 in terms of probability of death, or number of people dying rather, and the $1 per $1,000 of face amount, those two ideas are really interchangeable. So what we can think of is if what we want is pure protection, in other words, all we want is we want to promise to pay a loss if it does occur, then the price for pure protection is $1 per $1,000 of face amount. And remember that the other thing that was 1 per 1,000 was the number of people who died per 1,000 of individuals in the risk pool. So those two concepts are really connected closely together. So if we look here and we were to graph on the x-axis here, time goes from time x to 100, and on the y-axis we have the dollar amount you'd have to pay for life insurance coverage or pure protection. And we also note here that that's also the same thing as the probability of the loss there, so the probability of someone dying. Now, clearly, as x increases, so as x goes from 20 to 21 to 22 and so forth, then the number of people who die will increase, so we can say that the probability of the loss is increasing. And it increases at an increasing rate, and so you can see that at first it increases very slowly, but then there's an exponential increase. And so basically, we can say that that represents that curve that goes up, represents its mortality curve, or it's what's known sometimes as the force of mortality. So x out of 1,000 would increase, the number of people dying would increase, but also remember x out of 1,000 is $1, how much you pay per $1,000 of face amount, so that's also representing the cost of pure protection. So one thing that is fundamental to understanding life insurance is that life insurance contracts fundamentally provide death protection, and so every time period the insurer has to collect enough from everyone to pay the cost of death claims, and that cost is represented by the line that you see increasing. So these are two things that are being graphed here to make sure everyone understands. One is the probability of the loss increases, probability of death increases, but also the cost of pure protection increases. It's a coincident line. Now, many types of life insurance products have premiums which are level premiums. And so what happens here, if you have a level premium, then you pay the same premium every year, but that doesn't mean that your cost of insurance is the same every year. That just means the premium is the same every year. So notice what happens at younger ages when X is low, the level premium that you pay is greater than the true cost of insurance, but then after a certain point, the level premium you pay is less than the cost of insurance. So you have this overpayment at the beginning of someone's life, for example, and then you have this underpayment as someone advances in age. And this over and underpayment is really the source of what we call cash value life insurance. That's why we have cash value life insurance. Okay, so now we have a basic understanding of pricing of any kind of life insurance contract. Whether it's any kind of life insurance contract, we start with the very simplest kind of life insurance, which is known as term insurance. So term insurance is very much like property and liability insurance. You have an insurance contract that covers one peril, and if you recall from our first webinar, a peril is the immediate cause of a loss. The only peril that's covered in a life insurance contract is death. And in the case of term insurance, it's covered for a specific time period. It could be a one-year term, 2-year term, 20-year term. So you're covered for a specific time period. If the insured event happens during that time period, so if death of the insured occurs, then the face amount is paid to the beneficiary. So you can say if the loss occurs, if the insurance contract pays out the loss. If no loss occurs, then nothing is paid out. So term insurance is sometimes viewed as, well, you're buying pure protection. Just like when you buy a property and liability insurance contract, you buy pure protection. So there's no cash value that builds up in term insurance. The policy value is paid to the beneficiary upon the insured's death, and obviously the premium will escalate with age because, as we've seen, the force of mortality increases or the probability of death increases. And so if you buy a term insurance contract, it's going to increase in age. Over time, the premium will be, and it is renewable, meaning that if it's a series of one-year term contracts, for example, then the insurer will renew the policy without evidence of insurability. So that means that someone doesn't have to go through underwriting every year to have their term insurance contract renewed. At some point, because of the fact that the premium becomes increasing, some people convert their term insurance to a permanent policy, and most common permanent policy that is available for is a whole life contract. So whole life insurance is different from term insurance in that the period of protection is much longer. It starts at the inception of the contract, and it goes to the whole of someone's life, although most whole life contracts will pay the beneficiary or the insured person the face amount at age 100. Most mortality tables stop at that point. It does accumulate a cash value because you do have a level premium structure. So as we noted in a few slides ago, the reason why whole life insurance has a cash value is because you pay more in the beginning years than you need to really fund the contract, and then you have less in the later years, and so it develops a cash value. It's a level premium structure, so it's unchanged premiums. And then one of the issues that arises in whole life insurance is now we've got a life insurance contract that provides two things. It provides death protection, which is what life insurance fundamentally does, but it also provides cash value, and some individuals, of course, buy whole life insurance as an investment. And so the natural thing that comes up is, well, what is my rate of return on this investment? If I look at my cash value as being some indication of my investment, what is the rate of return on the cash value? So this becomes a little problematic for consumers to understand in some cases because life insurance fundamentally is death protection, but oftentimes people may buy it or it's sold as an investment. And so naturally rates of return arise as an issue. So because of that, in the late 70s and early 80s, when interest rates were much higher than they are today, a lot of life insurance companies started developing what we would basically call interest-sensitive life insurance contracts. So what they did was and Universal Life is the prime example of this. So Universal Life is a very transparent contract, meaning that you can see exactly where your money's going. If you buy a whole life contract, it's very much like a black box. You cannot really see where your money's going. So what we do in Universal Life in the interest of transparency is we separate the three components of any life insurance contract. We say, okay, your premium dollars go in, and part of that premium dollar is to buy protection. So we separate the protection component of that. You could say basically you're taking part of your premium dollars and you're buying term insurance. And then you have money left over. The insurer collects their money for expenses, and then whatever's left over is savings. The reason why it's interest sensitive now is because the savings amount, which is perhaps the reason why people buy Universal Life, what is the rate of return on that savings? Well, what Universal Life did was, which was remarkable at the time or somewhat unique, is the insurer said, well, we'll give you a guaranteed minimum rate of return or interest rate on that savings, but if the market's doing better or some index is doing better that we're tying this rate of return to, you can always do better, but you can't do worse. So it allowed people at a time when there were higher short-term interest rates to actually capture those in a way that did provide them some downside protection. It's also very flexible. You can skip premiums sometimes in Universal Life. You can pay more to that. You can access your cash value. You can add additional insurers. But the risks are that you could have a policy lapse because the fact that you don't have to pay your premium every year, because the only thing that has to be paid every year is your protection and expense components. And so there is a policy lapse factor that's higher there. And also there is more investment risk on the part of policyholders, so there's variability in terms of growth in that case. We also have another product called variable life insurance, which looks less like life insurance than many of the things we talked about so far. So essentially what happens is you pay a level premium, the insurer takes out expenses, and then they also take out an amount to fund the death benefit, so that you can say conceptually you're buying term insurance, and then everything else is left over as a cash value. But here the difference between this and Universal Life is that the policyholder is free to choose whatever investment vehicles they want to invest their cash value in, from a range of investment vehicles that the insurer is offering them. So basically the insurer is guaranteeing nothing in terms of rate of return on the cash value. The policyholder assumes all of the investment risk, so there's more variability in terms of investment performance, but it does allow an individual to have tax-free investment account changes because of the favorable tax treatment that life insurance enjoys, which I will talk about in a moment. So again, variable life insurance contracts often are again more sold on the idea of an investment vehicle as opposed to a life insurance contract. And then we have variable universal life. So it's basically a universal life contract. So again, premiums are paid in, expenses come out, we take an amount to fund the minimum guaranteed death benefit, and then the policyholder has a choice of how their cash value is going to be used based on an insurer's account performance. In previous case in Universal Life, the policyholder really had no say in how the account was used. With variable Universal Life, there can be significant expense loadings, either front-loaded or back-loaded, and there's also mortality cost charges as well. There are other types of life insurance, and these are all just variations on a theme. Some insurers developed what we would call current assumption whole life, which the way I look at it is really a whole life insurance contract that acts a lot like Universal Life, because when an insurer prices life insurance, there are three fundamental assumptions they have to make. Remember, life insurance pricing is very different than pricing property and liability insurance because it is a very long-term contract. And so the insurers have to make assumptions regarding mortality experience. So what is the future rate of claims going to be if I have an insured pool? Mortality experience does change over time. Mortality experience actually improves over time. We also have to make an assumption about future expenses. And we also have to make an assumption about rates of return. So the one that's, of course, the most subject to variation is rates of return. So what will happen is we'll have a whole life insurance contract. The insurer will price it at the beginning, but then 7 or 8 years in the contract, they'll reprice it based on current assumptions. So if mortality experience improves, then we're going to charge less for mortality rates. If investment experience increases, then we'll give you more credit for your cash value. So it's very similar to Universal Life in terms of the types of risk that policyholders take on. We also have second to die insurance. So basically this is a life insurance contract written on 2 lives. It's not paid until the second person dies, and it's payable to a beneficiary at that point. Or we have first to die insurance. So basically you have 2 individuals who are covered under a life insurance contract. Once the first person dies, then the second person receives they're the beneficiary. So that's a way to fund sort of a survivorship benefit of some kind, or pay out an annuity to someone if, for example, a married couple has that. So we can also see from this chart we have here some convenient ways to sort of step back and look at some major differences between various types of life insurance. And again, these are sort of generic descriptions of life insurance. Certainly life insurance contracts do differ depending upon who is issuing the contract. But we can see that one way to, or several dimensions to distinguish between different types of life insurance contracts would be the time period, the death benefit, is there an investment or savings component, what's the cost, are the premiums flexible or not, and are there investment choices. So if you think about term life insurance as sort of being the standard bearer or the sort of where we start with this, term insurance, of course, is temporary. Yes, there is a death benefit. There's no investment or savings component. It's relatively low cost until you get advanced in age. The flexible premiums, you pay a premium that's specified by the contract, and there are no investment choices. And so you can see here that if you look at the next group, those tend to be permanent coverages. There is, of course, a death benefit in all cases. The next group does have an investment or savings component, so we have to worry about rates of return. Are they low cost? No. Those types of contracts are going to have a higher premium because you're essentially funding a cash value. Are the premiums flexible? It depends on the type of contract. Why that's important is because if they're not flexible, in the case of, for example, whole life and variable life, then the policy could lapse. If someone doesn't pay the premium a particular year, the policy is terminated. Whereas in the case of universal life, for example, as long as there's enough money in the cash value to keep the contract going, which means there's enough money to pay the expenses and also the death claims, then the policy continues. And then investment choices, again, vary depending upon which one you have. So that's a convenient way to think about various types of life insurance. One of the interesting things about life insurance is that life insurance enjoys favorable tax treatment from the Internal Revenue Service. So if you are the recipient of a life insurance contract's payout, so you receive a death benefit, it's not taxable to the beneficiary. There's no income tax on that at all. And it doesn't matter how much the face amount is. There's no limit as to what the face amount can be. And that's true for all types of life insurance, whether it's term insurance or for an assumption whole life, any type of life insurance. If we have cash value life insurance, which almost every type of product we discussed today is cash value life insurance, what you probably noticed is the product really has two components. It has a protection, a pure protection component, and it also has a savings or cash value component. So the question becomes, well, the cash value accumulates over time. That may be why you're buying a life insurance contract, because it's an investment. So it's credited with interest. It's just called, but it's inside the contract. This is what's referred to traditionally in the life insurance literature as the inside buildup. So there's no federal income tax for a policyholder with respect to any of the earnings on cash value life insurance. So this buildup, as cash value builds up, it accumulates interest or investment earnings, but there's no federal income tax for that. Now, that's true if the life insurance contract really is a life insurance contract, because you can imagine a contract where it's a whole lot of life. For example, let's say we have a $100,000 variable life contract, and let's say that of that contract, $90,000 of that is cash value. That's the investment component. Then there's really only $10,000 of mortality risk in there. So the IRS would probably look at that and say, that's not really a life insurance contract, that's an investment vehicle that has a little life insurance in it. And so if it's really not life insurance, we're not going to give you this favorable tax treatment. So one of the challenges when you have these cash value contracts is maintaining the appropriate balance between the cash value component and the pure protection component. And so the IRS has a tax law definition of life insurance under Section 7702. The other thing that, of course, a lot of people do when they buy life insurance is they make policy loans. So they borrow the cash value out. The interest is charged against that. The interest is not deductible to the policyholder if the policy is what we call single premium whole life or something we call an endowment contract. What do those two things have in common? Well, they're contracts where individuals pay a lot of money up front to buy life insurance, but they're really buying it as an investment vehicle, and the amount of death protection or pure protection is pretty small, and so the IRS says, well, those aren't really life insurance contracts. They don't really meet the definition of a life insurance under Section 7702. Now we turn our attention to our second item, which is the discussion of annuities. So let's think about what the risk that we're trying to hedge when someone thinks about buying an annuity. So let's say you've worked and saved $1 million. Maybe you have this in your 401k or 403b plan. And so someone says to you, well, you've retired, so here's your $1 million. So the risk you face is you might live a really long time and it might outlive your assets. And if you think about life expectancy, which is a little different than the probability of death, if someone is alive at the beginning of age 65, if they're a man or a woman, they can expect to live to age 81 and 85 respectively. That's life expectancy. So given that a lot of people retire at sometime in their 60s, then this is a real risk that they have. They might outlive their income. And you can see that 1/3 of women and 1/5 of men born today will live beyond 90. So life expectancy is improving as probability of death is decreasing. So this is what the annuities face. So let's say you did have $100,000 and you were going to invest it on your own. You wanted it to be relatively risk-free and you wanted it to be liquid. Well, think about what your rate of return could be in this marketplace. So this chart doesn't probably go down as low as it should in terms of average annual total return, but let's just say, for example, that you had $100,000 and you wanted to withdraw 10% of that every year, and you invested it at 8% rate of return, then you would have enough money to last you 20 years. So basically, you face two types of risk. You face longevity risk. You might live too long, and you also face investment risk. So wouldn't it be cool if you could go to the financial marketplace and buy a product that you could give someone your $100,000 and let them manage both those risks for you? And that's why we have annuities. So annuities really are the opposite of life insurance. So life insurance addresses the risk of dying too soon. That's mortality risk. And that does create a loss of income, of course. But annuities address the risk of living too long, which is longevity risk. So when we have an annuity, we have certain parties to an annuity contract. We have the insurer, we have the contract owner, and we have the person insured under the annuity who's called the annuitant. In many cases, the contract owner and the annuitant are the same person. So if I go out and buy an annuity for myself, then I'm the contract owner and I'm the annuitant. So I'm the person whose life the contract is written on. The beneficiary is typically not a party to this contract. So the purpose of annuities are to basically provide an income that cannot be outlived. It's also a tax-efficient retirement savings vehicle. So the accumulated cash value of an annuity is tax-deferred, and in many cases it offers guaranteed death benefits depending upon what the individual chooses to do. So basically the idea behind an annuity is you go to an insurance company, for example, you give them $100,000 and $1 million. You're a certain age 65, age 70, and then you say to them, I want you to manage the longevity risk and I want you to manage the investment risk. And so I want you to start paying me so many dollars per month for as long as I live. So if I live 6 months, the payments stop at that point. If I live another 40 years, the payments continue. So what I just described to you is a straight life annuity. So basically, the insurer is only paying the annuitant for as long as he or she lives, and the payments stop upon death of the annuitant. That's going to yield the highest monthly payout because the insurer is really guaranteeing nothing beyond just paying you for as long as you live. That forfeiture bothers a lot of people, so they buy annuity contracts that have certain guarantees in them. So one option is to have a life annuity with period certain. So I'll just give you a simple example. Suppose you bought a life annuity at age 65, and you said, well, I want a life annuity with a 20-year period certain. That means that the insurer is going to pay 20 years of payments at a minimum, but they would pay beyond that if the annuitant still survived beyond that 20 years. A refund annuity is similar in that we're going to pay you every month for as long as you live, but we're going to pay you at least an amount to refund a set portion to you. So if you give the life insurance company $100,000, you may say, well, I want to guarantee that I at least get $50,000 of that back. That would be so the more guarantees that you attach to the annuity, the smaller the amount of the monthly payment that the annuitant is going to receive.
Thanks, Rob. And we've arrived at the point where we want to poll our participants. And the question we have is, which annuity provides periodic payments to the annuitant for his or her lifetime, but stops them when the annuitant dies? And as a reminder, we'll keep this poll open for 30 seconds or until all participants have responded. The choices include A, straight life annuity, B, life annuity with a period certain, or C, refund annuity. You can record your answers in the polling dialog box, should be to the right or lower side of your screen. Okay, the poll has ended and we're looking at the results, and we see that of those who responded chose A, straight life annuity.
And straight life annuity is the correct answer because it does, it's an annuity that pays out as long as a person lives but stops when the annuitant dies. So there are no guarantees beyond that. Our final segment of today's presentation involves health insurance plans. And the way people access health insurance basically are one of three ways. One, they could buy health insurance in the individual marketplace. Most Americans get health insurance to their employer, so they have some sort of group health insurance plan. And then there are government insurance programs like Medicare and Medicaid. So this section will provide a very brief overview of the types of health insurance products. So we start off with the beginning, what we call traditional health insurance products. These are what we would call perhaps indemnity plans. So basically an indemnity plan is a plan where essentially the insurer's role is to indemnify the insured in the event of a covered loss. So if you recall from one of our previous webinars, indemnify means to make whole financially. So essentially what happens is in these cases, individuals have a need to seek medical care. They go out and choose any doctor or hospital they would want to. They incur expenses. Those doctors or hospitals are paid by a system called fee-for-service reimbursement. Then conceptually, the insured presents their bill or payment to the insurer, and the insurer indemnifies them. So this was the predominant way of providing health insurance up until about the mid-70s to 80s. People had indemnity plans. Indemnity plans could be for individuals, or they could be in groups, an employee benefit plan. So again, the thing to remember about an indemnity plan is that doctors are paid fee for service, and which means that for every service they perform, a separate fee is paid, and the role of the insurer is to indemnify the insured. The insured can go to whatever doctor or hospital they want to as long as they're licensed. There are no networks. There are no referrals needed. There's no really management of the health care expense going on in indemnity plans. One of the major players, of course, in the history of health insurance are the Blues, Blue Cross and Blue Shield plans. So they, in many marketplaces, compete with what we would call commercial insurers to provide various types of health insurance products. The Blues are, depending upon the state, they are regulated separately than insurers because they have their own enabling legislation. They were among the major architects of many types of health insurance plans that we have today. So you could have a basic plan for hospital care, and you could also have a major medical expense plan of some kind. These would be considered to be indemnity plans, and they would pay providers on the basis of fee-for-service. So for many years, in many marketplaces, what you had is you had commercial insurers and you had the Blues selling largely indemnity plans. The Blues have gotten involved in the managed care marketplace, and it was a quite natural thing for them because one of the things that is true about the Blues is, unlike commercial insurers, at least when they used to sell only indemnity plans, the Blues have contracts with doctors, what are called participating doctors, participating hospitals, that do give favorable reimbursement to those individuals who have Blue Cross and Blue Shield type insurance. So they really started this whole idea of paying providers directly as opposed to having insured individuals go out and incur costs and having insurers reimburse them. We also have a broad range of plans that are called managed care plans. And managed care plans are fundamentally different from indemnity plans because the insurer is getting involved in managing the process, managing the healthcare transaction, managing the care that's given in some cases, as opposed to simply just paying for it. So the fundamental difference before we move on between an indemnity plan and a managed care plan is really what role the insurer has in managing the size of the loss. So some things that you see that are sort of fundamental features of managed care plans that are prevalent in some or to some extent in each one of them are negotiated provider fees. So insurers have contracts with providers that negotiate various fees. You can think of this as providers are offering services at a discount. You also have reduced consumer costs in terms of the benefit structure or the insurance plan structure. So there may be, for example, a financial incentive for an insured person to use a particular doctor or hospital. You may have a trade-off in terms of consumer flexibility. You may, as a consumer, not be able to go to whatever doctor or hospital you want to, or you may have to pay more to do that. But these managed care plans do cover a standard set of services like indemnity plans would.
We have another question for the audience participants. Opportunity to put your thoughts into the Q&A dialog box. What do you think? What are the most prevalent forms of managed care plans? And you can put your responses to this in the Q&A box. You can also add any comment or question you might like Dr. Drennan to cover. And time permitting, at the conclusion of our session today, we may address some of these questions.
Well, the most prevalent types of managed care plans, it's like alphabet soup. So you have HMOs, you have PPOs, you have point of service plans, and you have EPOs. So that's really where the marketplace is today. So we'll start off with really the first type of managed care plan, HMOs. HMOs have been around for a long time, but they really made sort of an increase in market share in the 70s and 80s. So, and again, every HMO is slightly different from another, so these statements are very general. But HMOs only provide insurance coverage for network providers. So you have a network of doctors, and these are the only doctors that you're able to go to. So this is sometimes called a closed network or a closed panel plan. A term you hear now in the health reform debate is you hear this term of narrow network. So they only provide coverages for certain doctors or hospitals. The insureds pay a fixed prepaid fee. There are co-payments for routine services. So you might pay a $5 copay for an office visit, a $10 copay, and so forth. You have a primary care physician that you have to identify, and that's sort of your entry point into the healthcare system. And they would pre-approve any referral to specialists in hospitals, and the HMO might get involved in pre-approving the use of certain treatments and services. And so what we see here is we see the HMO in its role as an insurer playing more of a role in managing the care. In other words, what is appropriate for our insured as opposed to just paying for the care. So that's why we call it the managed care plan. Some HMOs are more strict in terms of how they operationalize this than others. But basically the idea here is that if you have an HMO, you have a little less freedom of choice, and you have to go through more hoops you have to jump through in order to access specialists and hospitals. We also have these plans that are called PPOs, Preferred Provider Organizations. Here you have a choice of providers, What happens here is that the insurance company has contracts with preferred providers. These preferred providers agree to a discount services to PPO insureds. You, as an insured person, if you go to a preferred provider, you have a strong financial incentive to do so because you may have lower deductibles, lower copays, and so forth, lower out-of-pocket costs. You do not need to select a primary care physician, so no referrals are needed. So basically, your choice is, do I go in or out of network? I have the freedom to do that, but there is a financial incentive to do that. I will tell you that today PPOs are very popular among people who have health insurance. We also have these things called EPOs, which are they're very similar to PPOs and HMOs in the following respect. EPO stands for Exclusive Provider Organization. So the insurers access fee for use of the network. There are fee schedules for medical service levels. So what you do is you contract with exclusive providers. It's very similar to the PPO model. These exclusive providers give a discount, but the difference is that if you are insured by an EPO, you cannot go out of the network. So you really don't have coverage for going out of the network, unless it's an emergency, of course. So the reason why this is perhaps results in a lower premium is because if I'm an insurer, I can negotiate a deeper discount with a provider if I know that I can channel more individuals to them as opposed to them being able to go out of network. We also have these plans that are called POS plans, point of service. So you do have some HMO plans that do allow individuals to go out of network. Those we call POS type HMOs. So it again provides coverage for use of out-of-network specialists. Members receive some coverage for using that, but it's very much like operating in an indemnity plan world. You are using a provider that we don't have a contract with outside of network, so we cannot guarantee what they're going to charge you, and also you will have to pay first and then get reimbursed. But you do have the ability to go out of network, which is what you did not have in a freestanding HMO. The Medicare program also has some variations on it. Of course, Medicare is for primarily the elderly population. Medicare has three parts. Part A is hospitalization. Part B is physician services. And Part D is prescription drugs. So the default option in Medicare is to have Part A, Part D, and then people can buy into Part D. Part A and B are very much like a standard indemnity fee-for-service model. You pretty much go to whatever doctor or hospital you want that accepts Medicare, which of course is a very high percentage. But under the Medicare Advantage program, this does provide some managed care options. So you can voluntarily trade in your standard Medicare Part A and Part D benefits in for one of these Medicare Advantage options. So there are some Medicare HMOs. So you'll be in an HMO environment. You might have greater benefits. You might have prescription drug coverage built in that case. We do have these PSOs, provider-sponsored organizations. Those are integrated platforms between physicians and hospitals. They're very much like what you're seeing now develop under the Affordable Care Act in terms of accountable care organizations. There are some Medicare PPOs. There are some plans that allow individuals to have medical savings accounts combined with a high deductible health plan. And then you have these private fee-for-service plans. They give beneficiaries a lot of flexibility. They can go to any Medicare-approved provider. And then there are special needs plans for individuals who perhaps have been institutionalized, who are eligible for both Medicare and Medicaid, or may have a severe chronic disability. So these are all different models in which Medicare can be built on. But remember, the default option is the standard fee-for-service, Part A and B. A very popular, growing in popularity type of health insurance plan form to have is what's called a consumer-driven health plan, a consumer-directed health plan. So basically, there are three components to a CDHP. One is you have a lower premiums in general, but you have a much higher deductible and higher out-of-pocket limit. So the deductible might be $2,000 a year as opposed to $500 a year, for example. We do not have deductibles for preventive care. And then to help an insured manage that deductible, there's usually an HSA or an HRA. Given HSA is health savings account, HRA health reimbursement account, to pay for these deductibles. So these are managed by the consumer. So you have an HSA, and that will help you pay your deductible. It also helps you pay for healthcare goods and services that are lower in dollar amount. So one of the things we talked about in the first webinar is what's the optimal use of insurance. Insurance is best utilized for those types of losses which are low frequency and high severity. So for low dollar amount in terms of healthcare expenses, it doesn't really make sense to provide insurance coverage for those. So we give you this HSA to pay for that, and then we provide you with catastrophic health insurance to pay for larger stuff, so that's why we have a much higher deductible. We also inject consumerism in these plans because we do give information tools to insureds to make decisions regarding prices of things and availability of physicians. Finally, we also have a discussion about the Affordable Care Act, which was passed in 2010 and been amended many times. So these are just highlights of the Affordable Care Act. One of the things that insurers were not able to do is they were not able to decline to insure children with what we call preexisting conditions. Also, adult children up to age 26 had to be covered under their parents' plan if their parents' employer did offer dependent coverage. There were no lifetime dollar limits on what we call essential health benefits, and there's a phase-out of the annual limits on those as well. I believe there's about 10 or 12 essential health benefits. And insurers must spend a set percentage of their premium on direct care or quality improvement. That's what's called the medical loss ratio regulation that's part of the Affordable Care Act. So to summarize, life insurance, of course, can provide financial security for survivors of an insured who dies, and there are various types of life insurance products that do vary depending upon how much investment risk the policyholder wants to take. Annuities can also protect policyholders against outliving their income, and health insurance plans cover routine and major medical costs and vary widely in terms of freedom of choice and how much financial responsibility is resting with the insured versus the insured.
Okay, thank you, Dr. Drennan. And we do have a little bit of time left to handle some questions. Here is a question on universal life. How can insurers pay a minimum interest rate after a prolonged bear market?
Well, that's a good question. It's difficult for them to do that. Many universal life insurance contracts were first priced and distributed in the late 70s and 80s when interest rates were fairly high, much higher than they are today. And so if, for example, a universal life insurance contract says, well, the guaranteed minimum is 3.5% on cash value, but we'll give you higher if we can get it, I can pretty much tell you that they're paying 3.5% and they're losing money on their portfolio. So that becomes a problem for insurers to issue these contracts with those robust, pretty high interest rate assumptions. I would say that any universal life contract issued today, the insurers are probably more careful, but that also makes universal life less attractive as an investment vehicle as well.
Okay, thank you. And we have another question. This one is about annuities. The question is, are annuities suitable for most people? What about those with bad health?
I would say if someone's in bad health, a straight annuity, life annuity, would probably not be the one they would buy. If they were going to buy an annuity, if they did want to hedge longevity risk and also investment risk, they would probably buy an annuity with a substantial refund feature or more guarantees in it. But generally speaking, if someone is in poor health and they don't think they're going to live very long, annuities are probably not a good idea.
Okay, well, thank you. Dr. Drennan, thanks for joining us today and sharing your expertise with our audience. Thanks also to all of you who attended this session. We appreciate your participation in our soft launch. Within a few days, you will be receiving an email message from us with a link to a post-event survey. Please remember that we need your feedback. This is your opportunity to help shape the development of these new delivery options. As a reminder, this was the third webinar in a 4-part series. Our next webinar will be on Monday, August 11th at noon Eastern Time. Dr. David Eccles will present Insurance Regulation and Legislation. You can register from links in the email we sent or simply visit www.griffithfoundation.org. Thanks again for joining us. This concludes today's session.